The first decline from the B wave high subdivides into a down, a rally, a down, a rally, and a final decline. In other words, 5 waves down. 1, 2, 3, 4, 5. That was a very strong indication that wave C indeed had begun. Because now you see you're getting 5 wave developments on the downside, again, suggesting that the one larger trend, which in this case is wave C, is pointing down. And of course, you're going to turn out right on that one. Now, once wave 1 is over, what do you know? It's time for some kind of counter-trend pattern. In this case, it'll be a rally. And we do get a bit of a rally right here. It could actually have ended there. After all, it subdivides into 3 waves, comes right back in the area of the previous fourth. However, in this particular case, the development fell to a new low in 3 waves, which indicated that this decline was counter-trend, and then moved up here into a peak of wave C. In other words, this circle 2 upward corrective pattern was a complex sideways correction. Why? Because prices actually entered a territory below wave 1. So now you can say with certainty that wave 2 was a sideways style correction. This is important because when we get to wave 4, you're going to want to apply alternation to decide what shape wave 4 will be. Notice that wave 2, the upward corrective pattern, ends right in the area of the 4th wave of the preceding impulse wave of the same degree. You knew that before wave 2 started, that that area was the most likely area for the rally to terminate if wave C indeed was in force. All right, once wave 2 is over, you're going to have wave 3 as a natural next development. Now, this commodity price is now heading downward, not up. So fear is not the driving force. Therefore, 5th wave is not likely to be the longest. The 3rd wave is. And we're back to the typical development of wave 3 usually being the longest wave. And sure enough, wave 1, 2 subdivides a long 3rd within the 3rd, which is again normal. Wave 4 and wave 5, a long 5-wave subdivision creates circle wave 3. Now, you're starting to get interested in this commodity as one that may be reaching a long-term bottom. You've had wave A down, wave B up, and 3 waves within C. What is left to occur? A rally for wave 4, and then a final 5th wave down. What are your expectations with regard to this? Well, the wave 4 rally is a counter-trend move, so it's likely to peak somewhere in the previous 4th wave area. Wave 5 usually carries prices to a new low, so you would expect when wave 5 comes up that you will take out this low for wave 3. And what have you known all along about where the ultimate bottom is likely to take place? It's probably going to occur somewhere near the low of that previous 4th wave, way back here somewhere, which, as we already saw, is in this area. You know a lot about this commodity. Let's follow it through and see what happens. Here comes a terrifically sharp rally at the end of the 3rd wave, and you already know several things about how that rally is likely to unfold. Number 1, it should peak near the area of the previous 4th wave. In this case, it actually exceeded it by a slight amount. What do you know about the extent of wave 4? What is it virtually not allowed to do, except in a future situation, perhaps by a few pennies? It can't go into the territory of wave 1. So there's no way it could have gone higher than this level. Once you got in this area and count A, B, C up, it's time to assume that wave 4 is over. Is it likely that wave 4 will then have further development? Is it likely that wave 4 is going to come down here and make a new low and then rally back up and get complex and be sideways? The answer is no, because you've already had one. And by alternation, since you've had one complex sideways correction, wave 4 is likely to be simple. Over rather quickly, very sharp against the trend, and not make a new low within it. All right, and that's exactly what happens once you count an ABC rally right up to where circle 4 is here. Now, what are you looking for? You're looking for the 5th wave down. How many waves should it subdivide into? 5, because it's going in the direction of the one larger trend. It's likely to make a new low below wave 3, and it's likely to stop somewhere probably higher than that area of the previous 4th wave. Your knowledge is increasing as the bear market is progressing. All right, let's look how prices actually moved. Right off the top of wave 4, you had a decline, a rally, a decline, a rally, and a decline. A very pretty 5-wave structure down to complete intermediate wave 1, this little 1 in parentheses. Notice if you look closely at that the internal subdivision is a very nice 5-wave structure, even on this weekly chart. Then comes wave 2, which is an ABC, does not carry to a new high. Wave 3 unfolds. Can you see the subdivisions in this one? Down, up, down, up, down. A beautiful 5-wave subdivision within wave 3. Notice that wave 3 is longer than wave 1. So already you can now begin to apply another guideline. The 5th wave down, intermediate wave 5 in parentheses, will probably be approximately the same size as the 1st. That's the idea of equality between waves 5 and 1 when 3 is the longest. All right, once wave 1, 2, 3 intermediate are over, it's time for a 4th wave. Wave 4 gets underway. Notice that it peaks exactly in the zone of the preceding 4th wave. That's the low of the 3rd subdivision, and this is the 4th. Already having told you where the likely resistance level would be. And now you're getting even more interested. This wave 2, by the way, is a sharp correction. There is no new low made within it. How was wave 4 supposed to develop? It was supposed to have a new low and be very complex. Notice it had an A, and this B went to a new low, and then we had a C rally to complete wave 4. We're going to look at the detail of that area of the chart on the daily chart now. This is a weekly chart of futures. We're now into the last portion of the declining phase, and you go back to your chart book and you say, now it's getting serious. I want to start following this on a daily basis to try to decide when the low is in place. This is a blow-up of the last 2 waves in the sequence. On the weekly chart, we're now looking at them on a daily chart. This is the end of the 3rd wave, and notice, as I said before, wave 4 was a complex pattern, a sideways pattern, indicating it would probably have a movement to a new low within it. It did so, A, B, wave C to the upside. For those of you who are versed somewhat in Elliott analysis, you'll notice that this is a diagonal triangle, which is the only formation which allows an overlap, and Dave will cover that this afternoon. Wave 4 ends, again, it was in the area of the preceding 4th wave, just where it should have ended. Now what are you looking for? You're looking for the 5th wave down, the 5th intermediate wave, the 1 in parentheses. How many waves should it subdivide into? 5 waves. It's likely to carry to a new low below wave 3 and is likely to end somewhere near the major bear market's preceding 4th wave. And now it begins to develop in an interesting way. Wave 1, wave 2, which is quite complex, you notice, a sideways shape. Wave 3 carries you down to this particular low. Wave 3 is longer than wave 1. Then comes wave 4, which is sharp and against the trend, unlike this rather complex sideways structure. And then you're ready for wave 5. If you look very closely at the daily ranges, even within this last minor wave 5, you can see a decline, a recovery, a sharp movement down with a gap in the center, that's the point of recognition, ending a 3rd wave, a little rally for the 4th, and a decline into the intraday low at the end. If you had an hourly chart and wanted to look at the subdivisions of this last decline, you would see 5 waves down into that low. If you went to your quote graphics machine and checked the 5th wave on the 5-minute bar chart, you would see 5 waves down right into that low. Well, for the moment, let's just assume that you're working with a daily chart. And for the moment that you've counted it correctly, and you've counted 5 waves down, you're at a new low below wave 3, you're into the area of that previous 4th wave low which preceded it years ago. You've counted an ABC from the top, 5 waves in A, 3 waves in B, 5 waves in C. Every one of the declining impulse waves within wave C subdivides into 5 waves. You have now satisfied all of the rules and most of the guidelines required under the wave principle. If you are to enter an order, you'll probably wait for a reversal to indicate that wave 5 is possibly over. You put your purchase in as soon as you decide that that has occurred, and where does your stop go? Right there at that low. And in this particular case, you have caught the end of a multi-year bear market, or at least the first major phase of a multi-year bear market. And look what you did to identify it. You counted to 5. That's all you had to do. Did you know what the fundamentals were? Did you know how many tons of cocoa were sitting in stockpiles? Did you know how many ships were laden with the stuff in the harbors? Did you know whether the crops were doing well that particular year? Did you know whether anyone had developed a substitute for cocoa lately? Did you know what the trend of chocolate consumption around the world was? You didn't know any of that. How about the technical aspects that most people might be interested in? Did you know what the psychology of investors was due to, say, the bullish consensus among advisors? You had no idea how many bulls or bears there were. You weren't following the put-call ratios or the open interest in the futures. What about all of the Elliott wave things you could have looked at? Did we do any channeling? No. Did we do any Fibonacci calculations to estimate where this might have bottomed? We didn't do any of that. There are some guidelines we haven't discussed yet that were not applied. All you did was count to 5. And you were able to identify the end of a bear market that was fooling people every single day it was in progress.